The case for a near-term recession is getting harder and harder to make. Hello again, and thanks for checking out this week's Fastest 4 Minutes in Finance. Well, the bulls have been making their presence felt this week in the stock market as the major indices surged following the release of October inflation data. Consumer prices were actually flat compared to September and up just 3.2% year over year. Lower energy prices helped drive the number down, but even stripping out food and gas, prices were up just 0.2% compared to the previous month and 4% year over year, which is the slowest pace in 2 years. A closer look at the data finds that just 7 of the 31 core components or categories of inflation were up month over month. The inflation news set off a huge rally in the stock market on Tuesday. The Russell 2000 index, which is made up of mostly small-cap companies, shot up more than 5%, its best single-day performance in more than a year. The NASDAQ, which is made up largely of technology companies, climbed more than 2%, its best day since April. Economists and analysts agree that investors believe this inflation news will cement a full stop on the Federal Reserve continuing to raise interest rates. But the inflation data was just the latest round of good news. The most recent jobs report showed the labor market is growing at a slower rate. Remember, that's what the Fed wants, to cool inflation and the overall economy, but not to the point of recession. The most recent GDP report showed the economy grew at its fastest pace in nearly 2 years during the third quarter. Finally, earnings growth is nowhere near recession territory. According to our partners at LPL Research, earnings per share for S&P 500 companies rose 5% year over year last quarter, and 82% of companies beat their earnings expectations. Excluding energy, earnings are tracking at a 10% growth rate. Now, a quick thought about where the potential growth is, also from our partners at LPL Research. Take a look at this chart. It's a chart of PE ratios. Now, that stands for price to earnings. This measurement is often used to determine if a stock price is a good value or not. The higher the PE, the less of a value. And you can see the so-called Magnificent Seven are the most overbought companies. That's the biggest 7 that make up the S&P 500. They are Alphabet, Amazon, Apple, Microsoft, Meta, NVIDIA, and Tesla. The S&P 500 as a whole is next, followed by the equal weight S&P, which just means the 500 companies are given the same percentage in the index. The last 2 on the chart are international indices. The point of the chart is that there are a whole bunch of companies that are trading at a decent value right now when compared to their earnings. Now, data is always subject to change on the next run, but the reality here is that a recession is not likely in the next few months, and there is still a good chance we don't get one at all. At the same time, we shouldn't get too giddy over lower inflation. While the Fed may not raise interest rates again, analysts and economists believe it will be a long time before they lower them. There will continue to be headwinds to borrowing for companies and individuals. The bottom line, the data is trending in a favorable direction, and as investors, we can't let bad news talking heads deter us from staying the course to meet our long-term goals. Thanks for watching.